Welcome back to Intelligent Investment Today. This is the podcast where we explore the principles that underpin long-term wealth creation. Not just in markets, but in the decisions we make every day with our money. Because investing does not begin with stocks. It begins with behaviour, with habits, with how we earn, spend and save. And today we're going to explore a powerful idea often associated with Warren Buffett. Like many of Buffett's ideas, it sounds simple enough on the surface, but deeply important once you think about it carefully. Buffett once said, "If your salary is your only income, you're only one step away from poverty." Now that statement may sound harsh, perhaps even exaggerated, but like many of Buffett's observations, it contains a deeper truth about financial resilience and financial independence. So today we're going to unpack what this really means. We'll explore the risks of relying solely on earned income, the comfort that comes from building alternative sources of income, and the behavioural traps that prevent many people from ever getting there, despite having the means to do so. So take a moment, settle in, and let's explore another lesson in value investing, as inspired by Benjamin Graham. So let's start with the statement itself. If your salary is your only income, you're only one step away from poverty. At its core, this is not about pessimism. It is about vulnerability. If all your income comes from a single source, your job, then your financial position is inherently fragile. Because that income depends on your employer, your industry, the broader economy, and factors that are often outside of your control. If that income stops, even temporarily, your entire financial structure can come under pressure. Bills still need to be paid, expenses continue, but the flow of money disappears. And this is the key point. It is not about how much you earn. It is about how dependent you are on that income continuing uninterrupted. Now contrast that with someone who has multiple streams of income. Perhaps they have investments generating dividends, rental income, or even a small business on the side. In that case, the loss of one income stream, while inconvenient, is not catastrophic. There is a buffer, a degree of resilience. And this is what Buffett is really pointing to. Not just wealth, but financial security. Now this brings us to the concept of comfort. And it's important to define what we mean by that. Because in modern society, comfort is often associated with consumption. A bigger house, a newer car, more TV subscriptions, more convenience, more immediate gratification. But this is a different kind of comfort. The comfort we're talking about here is financial peace of mind. It is the ability to sleep at night without worrying about the next paycheck. This kind of comfort does not come from spending. It comes from margin. From having more coming in than going out. From building assets that generate income. From creating space between your needs and your dependencies. And this is where many people run into difficulty. Because while the idea is simple, the behaviour required is not always easy. Let's talk about that behaviour. Because one of the most common frustrations you hear is this. I can't save enough. I don't earn enough. I don't have anything left at the end of the month. And in some cases, that may be true. There are certainly situations where income is genuinely constrained. But in many cases, the issue is not income. It is spending. Now this is where it becomes uncomfortable. Because it requires honesty. It requires looking at how money is actually being used. And often, what you find is not necessity, but choice. Multiple TV streaming subscriptions, frequent upgrades to perfectly functional devices, leases on expensive cars that stretch budgets, dining out regularly, buying things not out of need, but out of habit or impulse, or the desire to keep up with others. Individually, these expenses may seem small, manageable, justified, but collectively they can consume a significant portion of income. And more importantly, they prevent the accumulation of capital, which is of course the foundation of investing. Now this is not about eliminating all enjoyment. It is not about extreme frugality. It is about alignment, making sure that your spending reflects your priorities. And if financial independence is a priority, then your spending must support that goal. This brings us to another important idea: delayed gratification. In many ways, this is one of the defining characteristics of successful investors. The willingness to sacrifice short-term pleasure for long-term gain. To invest money today rather than spend it. To allow it to grow, to compound, to work for you over time. And this is where the connection to value investing becomes clear. Because value investing is inherently long-term. It is about patience, discipline, waiting for opportunities, and allowing investments to mature. But none of that is possible without capital. And capital comes from saving, from creating a surplus, from choosing not to spend everything you earn. So when people say that they cannot invest, often what they mean is that they have not created the conditions that make investing possible. And those conditions are, to a large extent, behavioural. Let's now consider the idea of wanting everything now. This is perhaps one of the most powerful forces working against long-term wealth creation. We live in a world of immediacy, instant access, one-click purchasing, next-day delivery. And this environment shapes expectations. It normalises the idea that we should be able to have what we want, when we want it. But wealth does not work that way. It is built gradually, over time, through consistent action. And when spending is driven by immediacy, saving becomes an afterthought, if indeed it happens at all. Now this is not a moral judgment. It is simply a reality. Money that is spent cannot be invested. And money that is not invested cannot compound. So every spending decision has an opportunity cost. Not just today, but over years and decades. And this is where perspective becomes important. Because the impact of small decisions, repeated over time, can be significant. Now let's bring this back to Buffett's original point. If your salary is your only income, you're only one step away from poverty. The solution to this is not simply to earn more, although that of course can help. The solution is to build assets, things that generate income, that work independently of your time. And this is where investing plays a central role. Whether it is equities, property, or other income-generating assets, the goal is the same: to create additional streams of income, to reduce reliance on a single source, and to build financial resilience over time. Now this does not happen overnight. It requires discipline in saving, patience in investing, consistency in behaviour. But over time, the effect can be profound, because as those income streams grow, they begin to change your financial position. You move from dependence to independence, from vulnerability to stability. As we come to the end of this episode, it's worth reflecting on the broader message here. This is not just about investing. It is about mindset, about how we think about money, about the trade-offs we're willing to make, and about the future we're trying to build. The idea that money provides comfort is often misunderstood. It is not about luxury. It is not about excess. It is about security, about having options, about not being forced into decisions by financial pressure. And that kind of comfort is available to many people, but only if they're willing to prioritise it, to make different choices, to think long term, and to act accordingly. And on that, we come to the end of this episode of Intelligent Investment today. I do hope this discussion has given you something to reflect on, not just in terms of investing, but in how you approach your finances more broadly. Because ultimately, the journey to financial independence begins long before you buy your first stock. It begins with how you manage what you already have. I'm David Coombs. This has been Intelligent Investment today. Until next time, stay safe and happy investing.